Hi, Steve Schlegel here. I'm a certified valuation analyst, among other things, which means I'm qualified to value businesses. Why would we want to value a business? It might be because we're looking at buying a business and we want to make sure that we don't pay too much for it. Could be we're selling a business and we're looking at making sure that we get all that we can out of it. It could be in an estate situation where you die and you need to report the value of the business. Could be in a gifting transaction or one of many different reasons. But when you're looking at valuing a business, I wanted to talk a little bit about the methodology that we use so that you can understand that better when you're trying to determine value or assessing value on something that you're buying. And when we value a business, there's really three approaches to valuation, and all three approaches need to be considered if done correctly. We know that business brokers use rules of thumb, and there's often rules of thumb in an industry that give you an idea as to what something is worth. But when we do a valuation as a certified valuation analyst, we do have to take everything into account. And the three methodologies are the asset approach, the market approach, and the income approach. And this is true whether you're having a real estate appraiser appraise your house. They take all of those into account. We take all of them into account when valuing a business. Let me briefly describe each. The first is the asset approach. And the asset approach simply takes a look at what is the fair market value of each underlying asset, looking at the vehicles and equipment. Certainly the cash in your checking account is worth whatever the cash is. What about your accounts receivable? Are they worth what people owe you, or is it likely you're not going to collect on some of them and it needs to be discounted? In any case, the asset approach says we're going to look at it like we're taking each of these assets and selling them individually off. What would I get for them? We total that up, and that is one measure of value in a business. The problem with using that method, though, is that it doesn't take into account something we call goodwill or blue sky. What sort of reputation has the business built? What sort of customer base and customer lists are there inherent in the business? All of those things often have value, and you should get something more than just the value of each underlying assets. You should get something for that blue sky or goodwill. So what I find is when we use the asset approach, it sets the base, the minimum that you ought to be able to sell the business for. Then we go on to the next. You can see the next is the market approach. And the market approach is what they use most often when valuing homes in real estate. Real estate appraisers will take and compare your house or your real estate to other properties that have sold within a particular period of time, make some adjustments, and have a pretty good idea as to what your house will sell for. Well, we can do that in business too, because there are databases published of businesses that have sold throughout the country over the last number of years. The difficulty with it, of course, is trying to find a business just exactly like yours or the one that you want to buy. So even though these are significant databases of information, typically it's really hard to find enough market data to make an actual comparison. So then we move to the third item, which is the income approach. And although we call it the income approach, I'll use a different example for you. I like to use cash flow, as many valuation analysts do. You can't spend income, but you can spend cash. So we take a look at what sort of cash of the business is generating, what its extra cash flow is, if you will. What money can be taken out of it each year by the owner. And whatever that cash flow that can come out to you is, it has a value, and we take and we capitalize that value. And a simple way to do that is if we wanted a 25% return on our money and a business was generating $100,000 a year in cash flow, well then you'd be willing to pay or sell for $400,000, because $400,000 times 25% is $100,000 a year. So it's a simple process of finding out what the cash flow is and then assigning a risk value. The difficulty for someone who doesn't work as a valuation professional is that you're not really sure what that risk factor should be, what that capitalization rate should be. And so one of the things valuation analysts will do for you is determine what that multiple might be. In another video that I have on valuing a business, I'll walk you through just kind of a quick and dirty, simple way to do this income method to value the business. It tends to be the most often used methodology because it takes into account not only the assets, but also that goodwill or blue sky, and gives you a truer measure in most cases of what the value of that business is. It's good to understand these three methods, and a good valuation person will consider all three and then choose the one that is most appropriate in valuing your business.